Welcome to the Ask Chris Real Estate Podcast with Chris Phillips from Keller Williams. A successful 20-year veteran in the Middle Tennessee real estate market with over 100 five-star reviews, Chris is known for his knowledge and integrity. Whether you're buying, selling, investing, or just curious, his insight will guide you along the way.
Welcome back to Ask Chris Podcast. I'm Chris Phillips here with the Phillips Group at Keller Williams, serving Franklin, Murfreesboro, Nolensville, and Arrington, and all of Middle Tennessee. Today we're talking about interest rates, and we have Dr. David Manier.
Unofficial Dr. David Manier with Primis Mortgage.
That's
Back
right.
at it again.
That's right. And we have the big question, 15-year versus 30-year.
Yeah.
We have permanent rates versus temporary rates and buy downs. And to break it all down, let's get started. So Let's start with the 15-year versus 30-year.
Yeah, it's just getting into it, right? So big thing I get asked a lot, right? Being the mortgage guy, what are rates looking at? When are rates going to come down? I need a cheaper interest rate. I'm sure you hear that all the time.
Yep.
I hear it all the time. Honestly, just was talking to Chris and was like, hey, there are some really good things that we have out here to kind of combat those higher interest rates that are out there and kind of make things more affordable for people, especially people that are more rate conscious versus payment conscious. We'll kind of get into it, right? So 15-year versus a 30-year, right? So kind of what's the difference, right? So in a nutshell, right, 30-year mortgage versus a 15-year mortgage, right? It's the terms of how long you're paying on your mortgage, right? It's like, is your house going to be paid off in 15 years or is your house going to be paid off in 30 years? That's the basics of it, right? So kind of what are the pros and cons of it, right? So pros, right? So your interest rate on a 15-year is actually going to be cheaper, usually about 0.5% less.
Why is it less on a 15-year versus a 30-year?
So it's all about payment, right? So if your payment is actually going to be a little bit higher on a 15-year versus a 30-year, right? Because you're paying your loan off faster, so your payment's going to be a little bit higher. To kind of offset that, they make the interest rate a little bit cheaper for you to kind of help with that.
Okay.
Yeah. So if we're looking at it, right, kind of what you're going to be paying. So let's just say around a $300,000 loan amount, right? You're buying a home, got a $300,000 loan on it, right? If you're doing a 15-year versus a 30-year, the difference in your payment is going to be roughly about $600 or so.
Really?
So you're going to be paying about $600 more if you're doing a 15-year versus a 30-year. So you're paying a little bit more, but you're having that cheaper interest rate right there. So you're cutting down and paying a lot less in interest over the long run.
Okay.
So if you're paying, let's just say you decide to go for the full 30-year, right? Which, that's pretty rare nowadays, but let's just say you decide that you want to go for a full 30-year and let's say go for a full 15-year, right? What's the difference on that, right? So if you're looking at how much you're going to be paying in interest, you're going to be paying more than double in interest.
Wow.
On the 15-year versus or the 30-year versus the 15-year, right? So if you're paying, $300,000 loan amount, the interest that you'd be paying on the 15-year would probably be about $150,000, right? If you're doing the 30-year, you're going to be paying it's like $330,000 in interest. You're going to be paying more in interest than your total loan amount is on a 30-year versus the 15-year.
Wow.
So in the long run, it's definitely more affordable and cost effective to do a 15-year versus a 30-year. It might cost a little bit more on the front end, but you're going to be paying a lot less over the life of your loan.
Now, y'all don't just have 15 and 30 years. Do you have a 20-year as well?
Yeah, so there's 20 years. There's different ones. Typically, whenever I'm talking to people, 30 years and 15 years are going to be the main ones that we look at.
Yeah. Okay. All right, so then the next one is permanent rates versus temporary rates and buy downs. Now, we talked a little bit about this when we were doing our new construction because this is kind of the bag of tricks that the new construction lenders are using.
Yeah.
So tell us a little bit more about that.
For sure. So two main ones, right? So there's temporary buy downs and then permanent buy downs. So the permanent buy downs are going to be your most common ones, right? So what we'll be doing is, I'll talk to you, like whoever's doing the application, right? You're looking to buy a home, right? So I'll say, hey, your interest rate right now is at a 6%. We'll just say that's where we're at, right? So interest rate right now would be at a 6%. So I could look at my pricing sheet and say, hey, look, we could get you to a 5.5, and it might cost you, $6,000-$7,000 to do that. I'm like, okay, you might be saving, $100 a month on your payment, but you're paying, $6,000 on the front end, right? So does it make sense for you? How long you plan on staying in the home, right? Do we want to look at, possibly doing a refinance in the future? And if we do, right, maybe we don't want to pay
who's paying that $6,000?
Right, or who's paying it, right? So that's the big thing to kind of differentiate with the temporary buy downs. So temporary buy downs are seller paid buy downs, right? If we're getting money from the seller, we can do what's called a temporary buy down. So the most common one that we do for that would be, let's say, a 2-1 buy down. So let's just go back to that scenario, right? 6% interest rate. So what a 2-1 buy down would be is, instead of, if it was $6,000 to get to a 5.5, just hypothetical situation, right? So that's where we would be there. That's permanent, right? If you're doing a 30 years, so that's your payment for all 30 years is going to be at that 5.5% interest rate. So if you wanted to do a temporary buy down, and let's say you really need a cheaper payment right now,
because you might be making more later,
right?
Or the interest rate could change.
Interest rates could change, right? You think that you're going to get a promotion in the next year. You're going to have some debts paid off. So your, total debts are going to be freed up, so you can afford a higher payment, whatever the case may be, right? So let's say a 2-1 buy down. So what that would look like is, for the first year of payments on your 30-year mortgage, it would be like you're at a 4% interest rate. So you'd be making payments like your interest rate was at a 4%. Then after year 1 is done, year 2, it would be like you're at a 5% interest rate. So, and then after that, from years 3 all the way to 30, you're at that 6% interest rate, right? But so you get those first 2 years of having the lot lower interest rate.
So how much is the cost on that? I mean, we had the 30-year when we're buying an interest rate and we're paying $6,000 of prepaid interest to get a certain rate. Now, what are we doing with this 2-1 buy down?
Yeah, so what that is you're taking that, let's just say $6,000. I don't know exactly how much it is off the top of my head. Obviously, it changes based on loan amount and everything.
And all these numbers are just theoretical, guys.
Yeah, so what we would do is, instead of, taking that $6,000, putting it towards that rate buy down, being at that 5.5% permanently, we just take that $6,000 and then use it towards the buy down. It could be maybe a little bit more, could be a little bit less, but that's all going to be what we're getting from the seller, right? That's all going to be seller paid. So this isn't something that you're going to be paying for yourself, right? This is something that you're negotiating in the contract. Hey, we really need that cheaper interest rate right now. That's something that Chris can negotiate for us. Hey, we want seller concessions so that we can have this cheaper interest rate.
And that's the other thing that I want to emphasize with this, is because the reason we have David come in every month and do this, guys, is because he is the first piece of the puzzle that has to go. In order for me to do my job correctly, I got to know the numbers. I got to know what you need. I got to know your plan.
Yeah.
Are you doing this to buy down? Are you doing it, why are you doing it? Well, I want to keep my cash on hand. I might need it later, so we're going to do an FHA or a USDA or whatever it is. So that's why it's so important to get with David beforehand, before we go shopping, because otherwise we're just kind of going in the wind and we really don't know what we're looking for.
Yeah, we need to figure out what payment are you comfortable with. One thing I'll tell my clients is, just because I can qualify you for something doesn't mean that I should qualify you for something. If we're looking at your budget and, I can qualify you for a $2,500 a month mortgage payment, but you and I both know that $2,500 is way out of your budget, that what you can actually afford, then I'll say, hey, let's look at something a little bit cheaper, find something that's more in your budget, and let's run with that. And we can go up if we need to. If you find that perfect house that we might need to stretch a little bit more, then we can make it work. But we're trying to not max you out so that you're not, house poor, right? So that you're not stressing if you're going to be able to make your payment.
And then the other thing is, we're talking about there's cheaper insurance rates depending on where you're buying the house.
Yeah.
Also cheaper taxes. You might be in the county versus city and county. So those things are important as well, and those things help you determine what you're going to go. So basically what we're saying here, guys, is get with David and then talk about your options.
Yeah.
And the important part about that is do you do a 15-year or 30-year? Do I do a permanent rate, or a temporary rate buy down? It all depends on how long you're going to be here, how long you're going to stay in your houses. And like we said, when we were talking about the end of the year stats, those people that bought those new construction homes are going to have to stay in their homes for about 4, maybe 5 to 7 years to get back to even Steven, just because of the money they basically paid.
Yeah.
The builder didn't pay it. They feel like the builder did, but the builder just raised the price $25,000 after you saw that. And if you don't know about that, go look in our library and go back to that and look at it, and you'll see what we're talking about. So, Dave, thanks for explaining that to us today, and appreciate you coming in again, and look forward to next month, and we'll get another subject. And hey, guys, if you'll hit the subscribe button down there, and then also tell us some subjects that you might want to talk about. We'd be happy to do that. That way we can get it in the queue and go ahead and get those subject lines about those things that you're thinking about. And thanks for tuning in to Ask Chris, and we look forward to seeing you soon.
For answers to all your real estate questions, ask Chris at the Phillips Group, Murfreesboro, Tennessee.